we are going to look at some of the things that we expected. My camera. A minute as I collect this one. I should. Okay, sorry for that. So we are saying we are going to look at financial reporting and analysis. We are going to have some highlights of what we are expected, so that we'll be ready for April sitting, that is April 2024. And you're going to see how simple this paper is. So the paper has 7 topics. Of course, the first topic is the accounting for assets and liabilities, and that one I know from the foundation level you are aware of what you're expected to know. Accounting for assets and liabilities. How do we account for assets and liabilities? As a general knowledge, you know that we have accounting equation, and you know what happens to assets and what happens to liability. We have, for example, if we talk over assets, all assets have a debit balance, all liability have a credit balance. All assets have a debit balance, and if we talk of liabilities, see that all liabilities have a credit balance. That is topic number 1. We've said the subject has 7 topics. We're not here to highlight the number of topics that we have. We're going to look at group consolidation in the same topic, group consolidation. We're going to have preparation or presentation of published financial statements. Now this is for all the listed companies. Financial statements, all the listed companies, they are supposed, it's mandatory for them to prepare published financial statement. So we shall see how they present that. Then shall look at cash flow statement. Shall look at I'm not arranging this in order. Analysis of financial statement. When somebody asks you why we call it financial reporting and analysis, it's because of this topic. Analysis of financial statement. Oops. Somebody can't hear me. I can see still my video is misbehaving here. A minute. Wycliffe can't hear me. A minute, Wycliffe. I look at my video here. I don't know what is trying to misbehave. I don't know why. Why is it trying to misbehave now? Is it trying to misbehave? So, sorry, Wycliffe, are you able to hear me now? Are you able to hear me? I've seen that video was a bit bland. Wycliffe, are you able to hear me? Wycliffe. I'd like to know whether you're able to hear me now. You are able to hear me now, so that at least we're able to proceed. I hope you are able to hear me. So we are saying that we're going to look at a topic known as analysis of financial statements. That will be a topic. Then we have public sector accounting. And very many other subtopics. This is just a highlight. But for today, I'd like us to look at this. How do we prepare a statement of cash flow. How do we prepare statement of cash flow? How to prepare statement of cash flow? That is what I want us to, because this time round, I don't think during April exam this will miss. Statement of cash flow. How to prepare statement of cash flow. When we talk of cash flow statement, we're guided by IAS 7. Is it visible? Not really. IAS 7 is the standard that governors in the presentation of the statement of cash flow. So for us to prepare statement of cash flow, we are guided by this standard. And as we know, I need to change my camera. Please give me a minute. I change my camera. Please give me a minute. I change my camera. Please give me a minute. I change my camera. You can see this one is not. It is misbehaving. Okay. Give me a minute. I change my camera. Is that okay? Is that okay? Is that okay? Is that okay? I need to change it. It will take me 5 minutes. Not even 5, but few. Change this. Okay, thank you for being patient. I hope now it's you're almost done. You're almost done. It's disappointing. Kidogo tu. Kidogo tu. Okay. Sawa. Okay, all right. I think now it's better. Asanteni sana kwa kuwa patient. Be patient for that. So we were saying that when preparing the statement of cash flow, we are being governed by International Accounting Standard 7. International Accounting Standard 7. And under this, we know that when we talk of cash flow statement, this is when you talk of cash flow statement, this is component of financial statement. It is a component of financial statement. It is a component of financial statement. It is a component of financial statement. I don't know. Is it too low? It is a component of financial statement. It is a component of financial statement, and we have two methods of preparing. Of course, we have two methods of preparing these statements. One of the method is the direct method, and the other method is indirect method. Indirect method. I have to confirm whether my video is okay as well. Between the two methods, you find that since we have three activities that do happen in the company. Three activities that do happen in a company. Those activities are A, operating activities. Operating activities. An example of operating activity are those activities that lead to generation of revenue. Operating activity. Then we have investing activities. So for the investing activity, we shall see activity like sale of an asset, purchase of an asset. You see, you are trying to do some investment in order to increase your revenue. Then we have financing activity as the third one, the third activity. Financing activity. Those are activity like issue of ordinary share, borrowing of loans, repayment, redeemable of some debenture, and so on. So those are activity that we call them financing activities. Sorry, my video is somehow hanging. We shall see how we will proceed. So those three activities will be presented here. Where we have these two methods. So for the method number one, is a direct method, since we look at what has been received and what we have paid. What we have received and what we have paid. So whatever that you receive, that we call it an inflow. So we shall be having an inflow when we receive, that we call it an inflow, and then we shall be having an outflow. When we pay out. We refer that to as an outflow. In this case, this will be represented with a positive, we add, and this is represented with a negative. A positive and a negative. So if, for example, the company receives some money from debtors, that means that is an inflow, and it is leading to an increase in cash of the company. If the company pays some money to its creditor, that is an outflow, and it is lead to a reduction of cash in that company, and therefore that is an outflow, and we less that. Remember, at the end, we want to see the balance of cash in that company. When it comes to the method number one, since we are having three activity, operating activity is where the difference come in. We only have the difference in the operating activity for the two methods. For the indirect method, you find that we shall be adjusting the profit before tax. Or else the loss before tax. So I want us first of all to look at indirect method. want us to look at indirect method. So for the indirect method format, of course, you shall be having two columns. You shall be having two columns. Sorry. I wish that my network is... I'm having some challenge with this camera. Don't know why. Don't know why. But we must overcome. Kisumbua zima tungangane kabisa. Okay. So we are saying indirect method. When you're using the indirect method, of course, we shall be having two columns here, and then we shall start with the operating cash flow from operating activity. Cash flow from operating activities. So under this, under cash flow from operating activity, we shall be having profit before tax. Profit before tax, and you record that. You can record it maybe in the first column. Then you adjust. You do some adjustment for this item that we call non-cash item. For non-cash item. I hope now my video is okay. Non-cash item, and it's easy to know some of these non-cash item and why we refer them to as non-cash item. An item like depreciation, that is known as a non-cash item. Since, remember, every company has different way of providing for depreciation, and therefore that is a provision item. It's a provision item. You can see some people say 25% of the PPE. Depreciation was 25% of the PPE. Depreciation was 30%. It was provided. So that one is not the actual depreciation. And therefore, we refer to those items as non-cash items. So we have depreciation. Depreciation will be one of the non-cash items. Then we have finance costs. Still, finance cost or the interest charge on loan is also a non-cash item. But I want you to tell me in the income statement, what happened? What happened to depreciation? Is it added or is it subtracted? Or is it treated as an income or an expense in the income statement? How do we treat depreciation? Somebody to answer me that. I'd like to see your chart. Let me see. I think I need to see the chart here. I have to see your chart. What happened? What happened to the depreciation? Of course, this is treated as an expense and it is subtracted. So when we come to this profit before tax, that means this one does not have depreciation in it. It was subtracted. And because we need to know the actual cash at the end, we shall be adding this depreciation back. So you add it back. The same case to finance cost. It was subtracted as interest, as an expense. Therefore, you add that back. Then we have something to do with the impairment. You can have impairment. Amortization. Remember, all these are reduction. These are reduction of value. You add them since they are subtracted in the original income statement. Then we have gain on sale of asset. Gain. Somebody to tell me what happened to the gain. Is gain an income or an expense? Is gain treated as an income or an expense in the income statement? Gain. Somebody. It is an income from Regina. Yes, since gain is an income, it was added to these. For us to arrive to these, it was added for us to get our profit before tax. Therefore, we are going to subtract it in order to adjust this profit to its normality, Therefore, for that one, we subtract. We shall not talk about grants. Sometimes you find that there are those government grants. We shall look at it when we shall be opening an account. Now, after you reach to this point, whatever that you get here, it will be cash flow before changes in working capital. Cash flow before changes, adjusting for changes in working capital. And then you come and put your changes in working capital here. Changes in working capital. So for changes in working capital, I know you people know what are those working capital items. Working capital items in a company. Working capital items like inventory. Inventory is a working capital item. So we need to know what happened to the inventory during the year. We have receivable, those people who owe us. Then we have payables. For the cash, we do not include cash here. Because remember, cash will be the balancing. We shall be balancing using the cash. When we talk of inventory, what will happen? How shall we know what happened to our inventory? I want to show you a simple way to know this. I think we have 2020 here and 2021. So this is previous year and the current year. Inventory. So inventory here we had 200 and here we have 300. So what has happened to our inventory? In this case, if I look at the inventory at the beginning, that is the year 2020, I'm having 200, may it be million or such. The value of inventory is 200. And 2021 is 300. So is there an increase or a decrease of inventory? Somebody? Is there an increase or a decrease of inventory? Somebody. There is an increase of inventory. You ask yourself, what happened to cash? Did it reduce or increase? What happened to cash? That means in 2021, there was a purchase of inventory. And since we are drawing cash flow statement, you ask yourself, what happened to cash in this company? Did the cash increase or decrease? That is the way you ask yourself when it comes to asset. Did the cash increase or decrease? Cash decrease. Therefore, that means that cash decrease, it will be an outflow. So never struggle when it comes to the assets. The same case we happen to receivables. For you to know which amount you are going to record here, it is easy. Just be taking the opening inventory or opening value. Let me just say value because still we shall be having opening receivable minus closing receivable. Whatever that you get is your value to record. If you get it as a negative, you record it as a negative, showing that is an outflow. If you get it as a positive, that means it's an inflow. So in our case, we shall be having 200 minus 300, which will give me minus 100. That means an outflow of cash of 100. That means they purchased inventory worth 100. So just use this formula: opening value minus closing value. The vice versa happened to the payable. You shall be taking the closing minus opening. Therefore, if we had payable here, and this is 100, and this is 50. I'll just take closing, which is 50 minus 100. I don't have to think, and this is minus 50. That means there was an outflow from the company. That means the company paid for that, paid for that. Are you getting? Please confirm whether we are together up to that point. Are we together? You can say that using Y for yes and N for no. If you say N for no, we shall clarify where you have not understood. Y for yes, that means we are together. So are we together, really? Depending with that. Those are free marks. You cannot afford to miss this. You cannot afford to miss this. We have said that for this you take O minus C, and for the payable you take C minus O. As simple as that, and then you record whatever that you get here, and you'll be good to go. Are we really together? And see, Regina is confirming we are together. Regina is confirming that we are together. Any other person that we are together? Where are the rest? Wengine tuko wapi? It's either we are together or we are not together. All right. Now, thank you so much. So now, those are payables, changes in working capital. After you're done with that, now you can do your computation here, calculation here, and you get your what? The cash flow after working capital, changes in working capital. The cash flow after changes in working capital. From that point, what you do is to subtract tax. And remember something I want you to get. There are some accounts that you should be comfortable to create. So if we say tax account here, lazima come up na tax account. How do we create tax account? So tax is a liability to the company, and therefore it has a credit balance. So balance brought down, we shall be having it there. Then balance carried down will be on this side. I want to show you how to get. You don't pick the tax direct. You don't pick the tax direct. Then our tax can be affected by tax in the income statement. Kuna tax itakuwa kwa income statement. Then whatever that, if the balancing figure is on this side, that is tax paid. And this tax paid, unaweza iweka bank, unaweza sema ni bank, all right? This is if it is on the debit side. If the balancing figure is on the credit side, remember this is debit, this is credit. This will be tax refund. And this tax refund, remember it is a what? Tax refund. It is an inflow, right? An inflow. Tax paid and outflow. So itakuwa outflow tutatoa, itakuwa inflow tutaongeza. So it depend with the balancing figure yenye utapata. Lakini lazima ufanye tax, lazima uifanyie working. Tax na grant, government grant, together with the PPE. Those one you need to do the T account, so that you're able to get the actual value. So you less tax, or you add, if it is a tax refund, you add it, then you less interest. So interest, if you go to additional information, not really additional information, but under current liabilities, and find that you given some items of interest, maybe 2020, 2011. That means you are going to adjust for this interest as well. See? So umepewa maybe interest hapa 20, hapa ni 30. Naona? Alafu kwa income statement umeambiwa finance cost ni ngapi? Maybe ni 50. You have to come and adjust this so that you get the actual. This is debit, this is credit. This is a interest account. So interest is an expense. It has about a credit balance. Therefore, balance brought down will be what? For which year? Balance carried down the current year 2021 which is 30, and then tuko na nini, tuko na income statement inatupatia 50. So tunapata kwamba the actual interest to be paid here hapa kama ni 70, hapa ni 70, hii ni 40. Unaona hii amount hiyo ndio tunapeleka hapa pamoja. You need really to understand this. So this is interest paid. Sio yenye iko kwa income statement direct, sio yenye iko hapa kwa balance sheet. Hapana. You have to adjust to get it right. You have to adjust to get it right. So 40 will be the one to record, and you're going to subtract. So can see we have some few minutes. Remember we were to go up to 140. Naona tuko na dakika kadhaa pale. Please don't forget that hii semester tushaanza, and like to remind you of our services and whichever the cost, the charges. So at our college, still the intake is ongoing. And we offer the intermediate level paper, all of them, whichever that you are taking, we offer, and each goes at 4,800 each paper. This is per paper, 4,800. And if you wish maybe to pay, here is the pay bill, 6242,839. Account siweke hata unit yenye unafanya. Account weka unit name. Account unaweka unit name. Weka hivyo. You can forward M-Pesa. Forward hiyo M-Pesa message kwa 0719 525,000. Unaweza forward kwa 0719 525,000. We allow installment as well. You can pay in 2 installments. And lucky for you that we have 2 sessions. The morning session, call them early morning session, and evening session, for 2 papers, for only financial reporting and financial management. The 2 papers, at least you can choose which session you will fit you. So for the early morning, we start from 5 a.m. to 7 a.m. That is the timing. For the evening session, start from the 8 p.m. to 10 p.m. So depending on your schedule, you can choose which the session that suits you. You can choose the session that suits you. So if you choose early morning, just pay 4,800 or half of it, and then you'll be added to the paid group. Maybe I can open that chance for somebody with a question first, so that we're able to be together. Is there anyone with a question? Bado? Okay, sawa. Okay, let's see. We see the remaining time. So the second one is cash flow from investing activities. Cash flow from investing activities. Still 2 columns. You are proceeding with this one, but remember at the end here we have net cash flow from net cash flow from operating activity. Hiyo ndio inakuwaga ya mwisho, unaweka kwa column ya pili, net cash flow from operating activity. Then under this you can have maybe purchase of PPE, sale of PPE or asset, and so on. Unaziweka purchase, of course purchase ina reduce pesa, sale ina increase pesa. Then unaenda kwa financing, cash flow from here you can get net cash flow from investing activities. Unaweka kule kwa column ya pili, unaweka kwa column ya pili. Yes, unaweka pale kwa column ya pili. Haya, then unakuja unapata financing, cash flow from financing activities. Under this unaweza kuwa na issue of shares. Unaweka kwa column ya kwanza. When you issue share, pesa inaingia. Payment of loan paid. Ukilipa loan, pesa inatoka, inapungua. Unaona? Then you can have borrowing of loan. Ukiborrow loan, pesa inaingia, so that one you add. Then you put net cash flow from financing activity. Unaweka kwa column ya mwisho ili unapata net changes in cash and cash equivalent. Net changes in cash, na hizi ni free marks hapa chini. Cash and cash equivalent. Net changes in cash and cash equivalent ndio itakuwa hapo. Net changes in cash and cash equivalent itakuwa hapo. Then you add cash and cash equivalent brought down. Cash and cash equivalent brought down. Cash and cash equivalent brought down. Once you add that, whatever that you get there, it will be cash and cash equivalent carried down. Cash and cash equivalent carried down. Hiyo ndio itakuwa the final figure, and it should line. This is the balancing figure. The balancing figure, it should line with what you have as your cash plus any short-term investment kama iko short-term investment, then minus bank overdraft. Whatever that you will be getting there, itakuwa inakupatia the same. Lazima ikuwe hivyo. Still the same for cash and cash equivalent. Remember, this is for the current year and this is for the previous year. If the previous year is 2020 and the current year is 2021. Now we shall be looking at a question in our next lesson. Because you can see our time is up. But up to that point, have you learned something? Have you learned something new this new year? Tumesoma kitu. So I think that is it. We can wide it at that point. And we shall communicate when we shall be having the next class. Otherwise, thank you so much for having time to attend our today's class. May you all have a great afternoon. Otherwise, bye-bye. You can live at your own pressure.